Umar. Okay, so can you hear me?
Yes.
Loud and clear? Okay, great. Umar, it's such a pleasure to welcome you to the session, and thank you very much for confirming your availability.
Thank you for having me. Really appreciate it.
So basically, real quick, just to jump into the subject. When I think of Onyx, I think, okay, it's a cool name, and it's a business unit, creative technologies, blockchain, and cool, innovative solutions and platforms. So before we talk about Onyx itself, why the name?
Well, we were obviously trying to challenge how the infrastructure of financial services works. We also were trying to create something brand new and something a little bit mysterious and interesting for both our clients, our peers, internal people we wanted to hire. And we went through a lot of names. I think one of the examples I'd give you is if anyone has shopped online, once in a while you'd be buying something like shoes or pants or something, and the color comes up as Onyx. And you don't really know what the hell the color is. it's sort of black, but maybe not. So I think it was just enough mysteriousness about the name that's how we kind of converged the two things together, which is to create some mystery. At that point, we were trying to obviously be quite different from how banks generally did things.
Right.
So, I would say that actually the example of buying like pants or shoes that were called Onyx was one of the things that the team discussed.
Right.
Which, none of us actually knew what it was, but all of us kind of knew what it was. So.
Yeah.
Yeah.
So I'm going to try and demystify that right now in the 30 minutes that we have. So can you just give us a general overview of what Onyx is about, how it came about in terms of establishing this unit, what kind of objectives you have for the unit, and also what kind of future vision you have?
Onyx started in 2020, but the journey started a long time before that. So right about 14, 15 timeframe, so early 2015. I was at that point, I was working in the infrastructure side of our wholesale bank. And blockchain tech was very new because Bitcoin had been around for 4 years, but it was sort of a one-trick pony. This is the days when people used to buy pizza with Bitcoin, which I'm sure all of them are regretting now. And then Ethereum came around, and Ethereum, which was the next iteration of the blockchain tech publicly, was more of a general purpose computer. And that's where the thought process came about, saying, okay, can we really think this technology could disrupt how markets worked or how money worked? How do we think about it? And there was a couple of smart people who were very well versed in this. This was their passion. And I was asked to babysit that team for 3 months, like those two people, saying, okay, in your afternoons, can you just oversee them? You kind of know enough about tech. You can be dangerous. And that 2-person team is now 250 people. So that team grew a lot. And Onyx was a step, almost like an inflection point. So we went from, I think, 15 to 19, 20, and we did lots of stuff. And frankly, most of the stuff was kind of useless. We did it, didn't really work, or there were POCs or pilots or whatever. But right about 19 timeframe, we started to coalesce on 2 or 3 ideas, which could be quite big and could be infrastructure, like new infrastructure type ideas versus I'm going to do one more transaction where I do a bond on some blockchain, which we had done before, or I'm going to do money movement from point A to point B, which we had also done before as tests. But how do you really think of these things as being truly disruptive of how banks work, not just in payments, but in payments, in markets, in commodities, and all kinds of stuff? And that's where we started coalescing, and we sort of coalesced in 3 verticals: information, money, and everything else. So, and that's how we basically said, okay, if these 3 things are meaningful things, how do we go forward from here? We had built our own blockchain framework called Quorum, which is essentially, think of it almost like a programming language. And I don't think banks are really in the business of building programming languages, but we had done that. We ended up selling it because, frankly, we started getting calls from, actually consumer retail companies saying, hey, can you give us tech support? And as a bank in the US, I wasn't even sure how you do that because I think we're not allowed to do it, supposedly, some of those things. So we ended up selling it. But when we got to those 3, the inflection point was either we give them out, you can sell them, you can go into utilities, you can go into consortia and then spin these ideas out, or you double down and build them. And I think we decided path 2 for various reasons. And those three big verticals actually became part of the Onyx business unit. And so if I look at Onyx today, it's basically actually those three plus R&D, but those three, the information network called Link, the money part, where JPM Coin and several other technologies live in money, and then our digital asset platform, that is a general tokenization platform, where we can tokenize anything, securities, commodities, liquid assets, whatever we want to tokenize.
Great, lovely. So you used a lot of key terms, and if you don't mind, I'm just going to pick out a few of these key terms. I'd appreciate your viewpoint as JP Morgan looking inward, and also JP Morgan as an industry leader addressing the banking community. So let's start with, you mentioned money, so the future of money. So you have traditional finance and you have decentralized finance, and there's a lot of talk around both. Where do you see both lines heading? Do you see a convergence? Do you see them in parallel, or one replacing the other down the line?
So, I mean, I'm going to try to not be disparaging towards the DeFi folks, because I've been accused of doing that in the past. But I think the DeFi has interesting ideas, which is, can we do things without having a central body? And so just for people, I mean, one example of this is there's a protocol called Uniswap, there's one called Sushi. There's a lot of these swapping protocols where if you had two types of crypto assets, so let's say you had Bitcoin and Ether, you can go into this protocol and you can become a market maker. And the whole thing works in a decentralized way where the computer matches you with others and transactions happen, et cetera. Now, that's an interesting idea because you could see that applying to FX markets one day. Right now, FX markets are dominated by a few banks, including us, but you could see it getting more democratized. So the ideas are there. It's not going to achieve what I think what the DeFi folks have been beating the drum about for many years, which is DeFi is going to be the end of regular finance. It's actually not going to be the end of regular finance, at least not for the foreseeable future. At least I don't have to worry about it. Probably my kids don't have to worry about it either. So I think this is a long time to go. But the ideas from DeFi could impact how we think about access to markets, how we think about transactions, how we think about payments, where instead of everything having to go through a central player, you could have a point-to-point transaction. But ultimately, there are good ideas, and then there's a lot of noise in DeFi. So the noise in DeFi is there's a lot of fraud, to be very honest. Like there's thousands of tokens floating around. Yeah, maybe like a few of them might have some value. There might also be securities, who knows, depends upon the SEC's point of view. But most of them are just snake oil. So I think there's that. There's a bunch of snake oil floating, so which kind of the signal noise ratio is very bad in DeFi. So I think that's one issue. Yeah. I think the other issue is the monetary structure has been built over the last few hundred years, especially over the last, say, 70, 80, 90 years since the Great Depression. There's been lots of testing, regulation, et cetera. All of us as banks, whether we are in payments or trade or treasury or whatever, I mean, you can say anything about regulation, but ultimately the regulation is there to protect the system and to protect the ultimate consumer. And not having those in DeFi at this point is just a recipe for disaster, whether it happens now or happens 6 months. You just never can foresee the issue until it happens. And banks have been at it for, again, 100 years. And we still have issues. I mean, look at last few weeks. So I think there's a long way to go. I also don't think DeFi will take out centralized finance. I do think some ideas will come into finance and most likely have, sort of uplifting effect on payment infrastructure and markets infrastructure.
That's sort of a relief, I'm sure, and other members would probably feel the same way. Now, you mentioned fraud. And yesterday, we had a Future Leaders presentation that talked about technology and fraud prevention in trade finance. And one of the recommendations that came about is that banks end up dealing with each other on a blockchain system, on a blockchain platform. But there are challenges to blockchain. There's low scalability. There's energy consumption in a world of ESG right now. There's complexity. So not all of us can wrap our heads around the technology. So how do you address that?
I think all those are true, by the way. I think blockchain is not meant to solve a lot of the problems. Yeah. It is meant to solve certain problems, and you can find which problems they are. So for instance, we do information exchange on blockchain. We can exchange that very quickly because information does not need to be kind of confirmed by everyone else. When you're doing payments or when you're doing market transactions, they're slow. So yeah, maybe if I really, really push the system, I could get tens, maybe 100 transactions per second, but it'll never reach what ACH systems do across the world or what low-value payment systems do. So blockchain is not the solution to most issues. Most issues can be solved either without blockchain or with minimum blockchain type initiative. I just think we've sort of gone through a cycle where at one point everyone thought blockchain was going to solve every problem. Now we are, by the way, in the cycle where everyone thinks AI is going to solve every problem. But none of these things is going to solve every problem. They're just going to be cycles, and then there'll be iterative improvements. And we'll hopefully take these in. What we do at Onyx is we basically try to solve what we generally call the Goldilocks problems, which are not so complex that a blockchain, you can throw a blockchain at it, you can throw whatever you want at it, but you can't solve it. So the example there is syndicated loans. So anyone who's been in syndicated loan markets or whatever, this is a terrible product class. It takes like T plus weeks to settle. There's a bazillion signatures, all kinds of parties. And many of us have been trying to solve it on blockchain for, frankly, the longest time, and we've made no progress. You can do an experiment, but you cannot scale because there's so many parties involved, et cetera, et cetera. I actually would put trade in a similar category, which is ultimately the trade market is so fragmented that you cannot have one party or two parties just jump up and say, I'm going to have a blockchain. It just doesn't really work because of the fragmented nature and the lack of digitization in the actual trade process itself. You have people passing around paper. So what to put in blockchain, like what are you going to do? Paper is still paper. It's still going to exchange hands. So I think there's very complex problems. And then there's already solved problems. So, equities. Equities trade at extreme speed, at extreme throughput, volume. They might not settle T plus 0. By the way, that might be by design because, especially in the US, we like suing people. So, we want some time before we finalize things. So if you have to sue someone, we can do it. But, equities are an extremely efficient market. So like putting it on blockchain gets you nothing. There is no incremental efficiency. So you have to find that middle ground. So, for us, it's been things like repo transactions, which is not a ton. There's a few a day. But the technology can fundamentally change how those transactions work.
Right.
Yeah.
So you mentioned as one of the three main pillars of Onyx that you have information. So I would presume it's data.
Yes.
And I'd like to couple that with collaboration because right now this is the focus of the community. The more we collaborate, the more we communicate, the better the system is and the better the banking community is. So on that point, you actually worked on collaborative projects and platforms. So you've mentioned, I've been researching the site. So basically Project Guardian, you mentioned Partior, you mentioned Link. Can you just shed more light about those initiatives?
So I think I'll start with Link, which I think is probably the strongest case for collaboration. And Link is a network where you can exchange data, but then on top of that, you can have applications. So think of Link as the operating system, and then you can build applications where banks or non-banks can exchange data. Our primary application on Link is called Confirm. Now, Confirm is purely a data validation app, which is before sending a payment, I can basically query another bank saying, hey, I'm going to send it to Umar. His account is 12345. Yes or no? Is this accurate or not accurate? That, especially in the cross-border context, essentially saves quite a few breaks. Again, not everything breaks, but when you're sending out, let's say you are an e-commerce company from the US and you're sending just tons of payments to India and you're sending tons of payments to Africa and all these places, the ability to confirm that the account is actually valid saves you a ton of money, not just in terms of the bounced payment, but even in the pain and suffering which you go through and your client goes through, because now the payment is like, I don't know where it went, who got it, blah, 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 all kinds of madness. And this application, we co-founded with Deutsche. Now, I think a few years ago, it would be unthinkable, not unthinkable, but close to unthinkable, but for JP Morgan and Deutsche to get together and launch something. But that was the purpose of Onyx, is we just want people to think about it differently, because I think there's some things which are just true. One, banks kind of suck at data. It's just generally true. Both storing it, having data models, having how to get value out of it, because we are in the trust business and we don't want to lose data. However, there's ways to monetize that data, which is not selling someone's data, but saying, I know that, I see Patrick sitting in front, I know that Patrick's account is with JP Morgan, let's say, or Chase in US, and if someone pings me and I answer, I can charge 2 cents for it, because that person might have just saved $1 or 2 or 10 or whatever, so there's a marketplace. So this creates a data marketplace. I think an even better example, which is in much more early stages, by the way, not advanced, is something we're trying to do on Link called beneficiary sharing. So
beneficiary sharing.
Bad Benny sharing. So
Okay.
bad beneficiary sharing. So if you think about us, JP Morgan Chase, we have our internal list of people we think are not good guys. This could be coming from the government. This could be based on our experience of fraud, whatever. We have this master list. So does Citi, so does Bank of America, so does Wells Fargo, so does every other bank. Now, if I share my list with every other bank, it doesn't take anything away from me because it's not like I'm losing market share or someone's going to say, and I now have the list. But it might be beneficial to someone else. So it's almost like there's some of these examples of data where you can imagine that the banks doing it together is a net positive value for everyone without negative for anyone. So I think it's those sorts of things on the information side have been very important to us from a partnership point of view. On the partier side, because Guardian was more of a one-time thing in MAS, on the partier side, again, our view has been that people talk about CBDCs and these central bank digital currencies and whatever. Yeah, I mean, one day maybe there'll be CBDCs, but that day is far, far away.
You think?
Yeah, I mean, it's very far away. So I mean,
just wanted to confirm.
I hope there's no central bankers, but I mean, anyone who's met central bankers, it's not going to be built quickly. So and then the other thing is be a central banker when someone calls and says I have an issue. I don't think any central bank has ever picked up a phone to service anyone. So that's a separate issue. So we'll see how we get there. But that's going to be a long journey. So in the shorter term, we have commercial bank money. So this is where banks essentially provide M1 to the economy, and M1 will get digitized quicker because we need to get there. Partier is the company we formed in Singapore, along with DBS and Temasek, and now Standard Chartered, again across banks, and we basically have a network where we can move digitized M1. Which is JPM coin equivalent of JPM coin for us, similar construct for DBS for Sing dollars, and so you end up creating these international clearing settlement systems on a digitized rails, on blockchain rails. So I think that's a thought process.
So to that point, it brings me to my next question. As I was stalking you on the internet, so more like researching you on the internet, I came across an interview that you had with Bloomberg in November 2022. And you actually alluded to that point. It was very interesting. You talked about tokenized assets. You talked about tokenized deposits. But when you mentioned CBDCs, so when somebody says CBDCs, you immediately think, central bank digital currencies. But you actually mentioned, no, commercial bank digital currencies. Yep. So if you could just shed even more light on that potential relationship between they're both CBDCs, but one is commercial and the other one is central bank. So it would be interesting to get that.
I mean, I'll take a step back. I think the CBDC is the movement of central bank, so let's call it central bank digital currencies. The movement was triggered, frankly, because of Facebook.
Okay,
because Facebook, X number of years ago, 4 years ago, 5 years ago, they came up with this idea of creating a coin called Libra. Libra really freaked out every central bank in the world because 2 billion people, Facebook is going to issue a currency, and then all of a sudden, what's going to happen to my currency? Because now, let's say you're sitting in India or Indonesia or Europe, most of the people are now transacting on Instagram and WhatsApp and Facebook using a basket that has, that might have euro and dollars in it, but might not have a bunch of currencies. So every central bank got freaked out. So the knee-jerk reaction was I'm going to do something. So I think that was one reason. The other reason was obviously China, because China has a central bank digital currency that they launched, the yuan, and because China did it, so obviously you got to do something because you can't not do anything, even if you don't know what you're doing, but you just have to do something. So I think there's a China reaction. So I think there's a FOMO plus Facebook effect that got these things moving. Now, you have to sort of split central bank digital currencies into two things. There's a retail central bank digital currency, and there's a wholesale central bank digital currency. What the difference? I mean, again, I'm oversimplifying. Wholesale is very similar to reserves today. So you could say, I'm going to do wholesale central bank digital currencies. Banks can have access to those digital currencies. Let's say very large organizations, clearinghouses, et cetera, can have access. Now, what that does is, all that is a new RTGS system, a new way to clear central bank money, clear and settle it on new rails. It's not a brand new concept as such. It's brand new tech on an existing concept. On central bank retail retail central bank digital currencies are much more complex. Because what you're saying is now individuals can have accounts at the central bank. That's a very complex task because, I mean, actually, by the way, in some ways we do have accounts central bank because we all carry paper cash. Paper cash in our wallets is actually, central bank's liability, so we do have some relationship there. But if you add that, then how do you make sure that in the credit crunch people don't move, like let's say, what was going on with the banks or has been going on with the banks for the last, let's say, 3 months. If everyone could just move their money to the Fed, all the money would move to the Fed, like all of it. Because why would you keep it in the bank? I mean, the banks would die. Right now, you still have some issues because you can't go to certain banks, et cetera. So I think retail is really hard to understand. Again, China is doing it, but their issue, their stated objective is they don't want a duopoly, which currently exists between Ant or Alipay and WeChat Pay. They want to have a government infrastructure because they don't want to have dependence on 2 private players. But if you come to the US, I'm not really sure that that sort of stuff makes sense. In a developing economy, that could make more sense, could be a replacement for cash and coin, could be because no one is banked anyway, so why not just make it a central bank's responsibility? So I think that stuff has a long way to go. The commercial bank layer above it is more likely to get there faster because we can make a commercial case for why to do it.
Yes. And
we know how to serve clients. We know what activities we're involved in. By the way, our clients are also very used to interacting with us. So if it's they're coming through, say, Chase.com or Citi's mobile app or Wells in the US, Wells' mobile app, they know how to interact with that. We can make it work. So I think, in my mind, the chances of the commercial bank digital currencies getting there is much, much higher than the central bank, at least for the, call it G7, possibly even G20.
Yeah. So we've talked a lot about payments and a lot of developments in that space. But the same cannot possibly be said about trade finance, where the pace is so much slower. Innovation is pretty much paced, let's just put it this way. What's your take on that? I mean, how do you see that pan out in the future?
I mean, I think it comes down to fragmentation.
Yeah.
I really fundamentally believe that a highly fragmented market is just very hard to innovate in. So, and things are so entrenched. And there's people in the ports in Dubai and Mumbai and like all these places. Like how do you even like move it to the next step? So I mean, for instance, like I think the Reserve Bank of India has done certain things, others have done certain things, but none of these things has been done at a global scale. And even the large players in trade finance, and JP Morgan is not the largest, but we are sizable. But even the much larger players in trade finance from a banking point of view, their market share is not it's not gigantic. Their market share is high, but not gigantic. So if they create something, how do they get there? And are they willing to take a risk? So I mean, again, whether it's because of Jamie or JP Morgan's approach, we are willing to put in a lot of money into something, say like an Onyx digital asset or JPM coin, knowing that it's very possible that we might never recoup that, but we want to basically take the plunge. The question is, would one of the biggest trade players, would they want to do it? Would they want to spend 50 or 100 million building something with the hope that everyone will come?
Yeah.
So I think it's a little bit of a roll of the dice.
Yeah. So yes, we have a couple of questions, so I'll just finish off my questions and then continue on Slido. So yesterday there was talk about the 4th industrial revolution. Yeah. And now we're in disruptive technologies, trends. You mentioned AI, virtual reality, and Internet of Things. And they pretty much impact the way we live and the way we work. So to that point, it brings me to the next topic, which is ESG. Yeah. So how do you see the digitization and the transformation trends? How do you see them evolve vis-a-vis ESG? Do you take it into consideration? Is this like a bit of a lesser priority?
I think it's a pretty high priority, just given where the world is.
Well, yeah.
And what investors are asking for. So even if you're not doing it out of the goodness of your heart, I mean, the fact of the matter is the world is going in a certain direction, and you have to go there. So there's been quite a lot of push. The real question is the linkage between the digitization and the reality. So for instance, I've talked to several players who want to get into some of these sort of, ESG type bonds, where you're giving money for certain activities in a developing country. And you want to make sure that that money is utilized in those ways. And that would change, that would change the nature of the bond, that changes the coupon, et cetera, et cetera. Everything is fine on the tech side. The question is, how do you monitor the human side at the end? And I think that's where the rubber really hits the road, which is you can record a lot of stuff, but as long as, if you don't have the sort of the infrastructure on the ground, it's kind of hard to do.
Yeah.
So I do think it's a little bit of a longer journey. It'll probably be easier in things like carbon credits because they're easier to measure, and you can say, okay, I got carbon credits because I have this grid, and the grid generated X amount of power, using solar. So those things are easier to transition. I think some of the components of ESG will take quite a long time, but it is at the forefront of a lot of work because people feel like if you're going to go after something new, which is ESG, then you might as well do it in a new tech.
As well.
Yeah.
Right.
Yeah. Upfront.
That's good to hear. So I'm done with my scripted questions, and now for the tricky ones.
All right.
And the first one is, how much payment volume is being validated on Onyx?
So I don't actually know the volume. I know that on a monthly basis, we do several million transactions are validated.
Oh, wow.
So probably around 5-ish, I believe, 5 million a month, which is, again, not a ton, but they're mostly high-value transactions. They're not low-value transactions because they're cross-border. Yeah. So I wouldn't know. I mean, actually, it's a good question. We just haven't kept track of the actual payment that's being. Yeah. So if I'm getting an inbound from a bank saying, I'm sending this payment, then we don't really tie it back. We don't actually capture the amount of the payment. We just, respond to whether the account is valid or not. So, yeah.
So the next question, information and energy infrastructure are actively becoming more decentralized. Won't the market naturally expect finance to become more decentralized?
I think that the market may expect it, but I think the regulators may not expect it. So ultimately, there is a lot of regulation in the space. And I don't think the regulators, whether they're in the US or elsewhere, they haven't really figured out how to monitor some of these more decentralized marketplaces. Yeah. But over time, yes, it could get more decentralized, though ultimately people will still want to go to a trusted party. So whether they come to our bank or they go to, a Barclays or a BNP or a DBS or whatever, people are going to come to banks because that is going to be their entry point. And that's what you see in crypto as well, by the way. I mean, in crypto, there's a lot of promise for decentralized. I mean, where do all the people go? Pretty much everyone goes to the centralized exchanges because I don't want to deal with my password, 13 numbers somewhere. Who cares? So, at the end, I think banks will have a very big role to play. The network might become more decentralized, more point to point, but that's not going to change the nature of banking in the near future.
Yeah.
So.
Good. So, so the final question, how does Partior with Temasek and DBS in Singapore fit into your plans with Onyx and JP Coin?
So, Partior is essentially, think of it as a clearing settlement system for our liabilities. So JPM Coin is more used internally. So our internal clients use JPM Coin, whether they're using it within their ecosystem or whether they're using it within groups of clients. So I'll give you a couple of examples on where we are using JPM Coin. So one of the examples is we are basically serving very large e-commerce companies that want to move their money around the world 24/7, and they want it linked back to their systems real time. So when thing A goes from here to here, they want money to go from here to here. And they use JPM Coin across, London, Lux, Singapore. We have a bunch of sites lit up, especially in Asia and Europe and US. So they can move that money around. That's one kind of use case. One kind of use case is ecosystem, where you have an industrial player with a lot of suppliers coming in, and they want the payments to be triggered automatically. So I think that's another use case that we are exploring. A third kind of use case, which I think is coming, is programmable payments. So we are increasingly looking at deploying, which is smart contracts, which is sort of what makes blockchains do certain things. I mean, they're not that smart. They're kind of dumb contracts, but they're called smart contracts. But it's think of it like if-then sort of things. And we can now do things that we could not do before. So, if one of our clients came to us and said, I want you to move my money every time it gets really cold in Texas or something, our systems cannot do it. I don't think many bank systems can take weather data in and do anything with it. But with a smart contract, you have to have a data oracle and smart contract, and you can move money based on weather or based on anything that happens in the world, as long as you have a verifiable source of data streaming.
Right.
So that's JPM coin, but think of it as within JP Morgan walls. Partier is across us and other, other players.
Yeah. There seems to be an interest in Confirm, yes. How many participant institutions are using Confirm?
I think the number is sub 100, but I don't know what it actually is. But it's on the website, though. I mean, there's people, the names are listed on the website. But
yeah, I didn't pick that up.
But I think it's sub 100. We had about 400 and some sign up. We haven't lit a lot of them up, primarily because the other thing you have to understand about these things is these are things that take real expense to integrate into your workflow. So if you're a bank, you can't just use Confirm. You have to somehow build it in your workflow, which might take X $1,000s or X tens of thousands of dollars. And that doesn't work if you are doing very small payment volume, for instance.
Right. So they're just really interesting questions. And I know that, where our time is up. So please feel free to approach Omar for any of the questions that you have, including what's on Slido as well. Thank you so much for your time. It's been a pleasure.
Thank you so much for having me.
And I hope you stick around.
I will.
Thank you. All right. Thank you, Omar.